Guys, the Fed made their decision. They're keeping rates the same as of right now, and they've said that they want to see more progress in inflation before they decide to cut rates further. But before we get into what Fed Chairman Powell is actually saying about this in his remarks, let's take a look at what the future holds in September based on people's probabilities of things happening, and what does a Fed rate cut now and in the future mean for you. So first off, CME Group. This is September. 500 to 525 is a 25 basis point cut. They're factoring in 93.5% chance. Guys, a 6.4% chance of a 50 basis points or 0.5% rate cut. That's not something to sniff at. That's 1 in 16 chance. So everybody's really banking on September. Now, what does that mean for you? Well, guys, I always say on this channel, if you're new to our channel, we do a lot of videos reacting to the market, economics, news, things like that. That's what this channel is dedicated for. So if you're interested in seeing 4 or 5 videos a week, just about what's going on out there, instead of really in-depth analysis in a company, subscribe to the channel. You're going to love it. It's going to offer you a different way of thinking. Guys, these Fed rate cuts should not matter for your investing style. We've talked about it time and time again. There are thousands and thousands of data points. Remember, the Fed started cutting rates in March of 2022. Started raising rates. They went from 0% to 5.25% to 5.5%. That's a big jump. Where the market's gone since March of 2022. They're up. Everyone thought that raising rates would absolutely demolish the market. And it makes sense because before the markets were built on the 0%. Okay, what's my other opportunity? If I get 0% in my bank account, I might as well invest in stocks. Now, you're getting 4 or 5% in your bank account. You're getting over 5% on a 90-day treasury. You would have thought that would drastically affect what's going on with the stock market. Yeah, there was a bear market in 2022. I do acknowledge that. But after that, just up and away to all-time highs. Real estate prices. Everybody thought, okay. And I made a video back then saying, guys, if inflation is high, it can still keep home prices going up. I didn't factor in the lack of supply. But if you look back at 1975 to 1985, rates went up 50% from an average of 9% to 13.5%. And yet home prices almost tripled in value. Why? Inflation. We're also coming off a weaker economy as people started to get back to working, paying more for houses. That's happening now. Another piece of information today came out that home prices hit a new all-time high. But people are saying, yeah, but the growth has slowed. Who would have thought that rates would go from 0 to 5.25 or 5.5 and home prices would have gone up from there? It's amazing, isn't it? It just goes to show, guys, you can't guess what's going to happen. There are so many data points out there. The economy is very complicated. It would have been so obvious to think that increased rates would have absolutely curtailed the economy. Guys, we're at like 580 some days of an inverted yield curve, and we haven't called it a recession yet. Or if it's even going to happen. Did we have the first ever soft landing? Could it be? Who knows? What I try to teach is a process for buying great companies at relatively great prices. If you're able to do that, I actually think worse economies and worse environments are better for you. But it won't affect your companies. If you buy crappy companies with crappy balance sheets, it will affect your company. Guys, a lot of companies in the last few years, before rates went up, locked in some 5 and 7 year debt offerings at very low rates. So what's going to happen 5 years later when they have to refinance? It's going to affect their bottom line. Now, in that time period, they could have really raised prices, really increased profit so they can mitigate that. But you look at real estate. We buy a lot of apartments. It made it easier for us to buy apartments when rates went up. Why? Because when rates were low at 3.5%, we weren't willing to make the assumption those rates were going to stay low. Everybody else who's trying to raise money from investors had to make rosy assumptions of, oh, rates are going to stay low. Now, rates went up, but their rents also went up. The only people that got the bite of it were people who were trying to sell right before rates went up or while rates are going up, and then saw rates come up and really affect the value of their property. But over long periods of time, if you lock in even a reasonable rate, if you're able to really raise rents, if a cost of living goes up or the cost to build your house, it continues to rise, guess what's going to happen to your house value? It's going to go up with it. Guys, something interesting before we go further. 1 day ago, the chance of a quarter rate drop on the September Fed meeting and a 0.5 point were 86% for just a quarter, 13.2% for the 0.5 point. It went to 93.5 and 6.5 today. 1 week ago, it was 90 to 9.7. 1 month ago was 58 versus 6.2. And over a third were saying there was going to be no rate cut. These things move very fast. Very fast. Remember that when you go forward. So before we get any further, let's go see what Fed Chairman Powell has said. So guys, I put a post out on Twitter. Fed holds rates steady for those of you who think that should affect your investing decisions, which it shouldn't. Buy good companies at great prices relatively, and you'll do well whether rates are 10% or 0% over the long run. Don't let the noise in the short run affect the decisions you make for the long run. That is so important. Don't let this noise bother you. There's a lot of bad things that are going to happen out there. Look at this chart. This chart shows all the presidents, a lot of bad things that have happened since 1950. And these aren't even close to all of them, guys. And guess what? Markets still go up. Because if you believe in the U.S. economy, if you believe in the world economy, and if you think that the U.S. will continue to grow along the way, you will do well over the long haul. Now, of course, our tensions tend to be short-lived. And guys, again, just like the channel, I comment a lot. I have over 4,300 posts. Follow me on Twitter at EMPaulG. It's right here below at EMPaulG. I'm very active. I love talking on there because that group of people on social media is the right group to have conversations with. Now, is there a lot of junk out there? Of course there is. And I encourage you to call me out on things you don't agree with. This is not a place for you to say, I agree, Paul, only. You can do it in a respectful way. Say, Paul, I don't agree with you. I just had that happen on this very post. And I love that. That's what the key is here. Now, I will always say the hardest part about investing is people looking at data points and feeling, oh, this matters, because we're overloaded with decisions to make. But guys, that's not what we're here to do. There was this person put a great analogy here that I absolutely loved. I want you guys to see. The concrete guy. He wrote, agreed. If I bought a good concrete plant at a great price and it rained for a month straight after purchase, I wouldn't run to sell the concrete plant. What a great comment. If you buy a landscaping business, you don't do that. You look at the long run. There's going to be 3 months where there's no rain or whatever it is. The key is buying good companies at great prices relatively, and you will do very well. That takes a process. That is what we're trying to teach here. We're not the channel to just hand you a stock and say, go buy this. That's not what we're here to do. I'm here to teach the process that works for me, explain it in a way that hopefully you understand. And if you agree with it, modify it for what your viewpoint is. One of the best investors I know, somebody who works for me, his name's Dalton. He's in our community. He is a great investor. We could not have any different views on what companies to buy, but our philosophy is the same. Our process is the same. He just gravitates towards these companies. I gravitate towards these companies. That's it. We apply the same process to companies that make sense to us, and that's what's really important. Now, what's going to happen this year? First off, Fed Chairman Powell announced 4.1% unemployment, which is still very low compared to history. I do think they deserve a lot of credit for the way they've handled these rate increases in inflation. Core inflation is down to 2.5%, according to what he just said, from over 7%. Their goal is 2%. Now remember, core inflation excludes the very volatile food and energy costs. So it's not overall inflation, it's excluding food and energy because those prices fluctuate like crazy. They've done a great job of this. 177,000 a month in new jobs in this last quarter, slower than the first quarter, but still good gains. Guys, a healthy economy should be between 5 and 6% unemployment. We've been spoiled by these low unemployment rates. People would be crying if we went to 5 to 6%. That's considered a healthy economy, a stable unemployment rate, and one that isn't really pushing up inflation. So the fact they've driven inflation down while still making gains in jobs, albeit higher unemployment rate, but we're talking about higher unemployment rate going from 3.5% to 4.1. That's like people complaining about interest rates. Oh my God, rates were 3%. Now guess what? It's still pretty low for history, or about where it should be in history. Let's not get spoiled by recent news. Let's not worry about that. What I want you to worry about is the long run. Now, I love talking about the economy in the short run. I love talking about these data points. That's why I'm on Twitter. I love having these conversations for exactly that reason. It is fun, but you got to separate your decision-making from understanding these things. It's really, really important to sit there and understand how economies work, but not make a decision or change your mind because of one data point that comes out. Guys, look at history and pack this photo again. Look at this thing. We had the housing crisis here. We had COVID here. Every past bear market looks like like opportunity. Every future one looks like a risk. That's what Morgan Housel says, and it's brilliant. Because if you sat there and go back here, when would you wish you'd invested? And all these bad moments, and guess what? But for the future, if I told you right now, market's gonna fall 50% next 2 years, you'd probably be, rightfully so, fearful. I would be too. I'd be like, okay, that sucks. But guys, you cannot crash-proof your portfolio. If you're so close to retirement that a 50% drop in the market would adversely affect your ability to retire, you might want to reevaluate what you're invested in. You might have to sacrifice some gains in order to provide more security for yourself. But if you're decades away or 10 or more years away, guys, every future crash should be an opportunity. That's what you want it to be. You want stocks to be lower. We love red days. I hate days like today. The Nasdaq's up 2.75, S&P's soaring, blah, 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 blah. Yeah, it's great. My stocks go up, but I want cheaper prices. I'm not fully invested. And even if I'm fully invested, I want to be able to sit there and say, where are I going to get more money and put in the market? That's what I was doing in 2009. I love my process. I'm buying great companies. I own 18 great companies, and that's my focus, to make that 30 or 40. I think that's the appropriate number for me. Is it too diversified? Maybe. But what matters is for you. Now, the final thing I'm going to say, cutting rates. I'm not going to lie to you. I'm a little apprehensive about cutting rates because to me, cutting rates would be reserved for what? Bad times. You don't just cut rates to cut rates. Even if they get the 2% core inflation, why cut rates there? Wait till it's going even lower and you're like, wait a second, we got to cut rates here, spur that along. So what's going to happen in September? I have no idea. I have absolutely no clue. And neither does the market. Look how much they've changed in one day, in 1 week, in 1 month. Nobody has a clue. But I'm telling you right now, if any one of your companies in your portfolio would be adversely affected by rates going up 3 or 4%, why do you own it? That's not a great company. I always tell people, if you need a great market in order to do well, you're not a smart person. You're not a good worker. You're terrible. It's absolutely, look at all the realtors out there who always made money because the market was booming. Now, what about now? I don't see as many people becoming realtors anymore. Even though the market's doing well for realtors, the number of homes for sale is a lot lower. And that's what I want to teach here. I want to make you find a process for yourself that works, that makes you a great investor during the bad times. So guys, 2 things: subscribe to the channel if you want 4 or 5 videos a week, and follow me on Twitter @EMPaulG. Thank you for your time.